Welcome to the videos for leases with guaranteed residual. And I said we're going to concentrate mainly on the lessor side. I did the lessee just to show you how it works. I just have the numbers already in there. But this is a guaranteed residual. It's a 4-year term, 5-year life of the asset. Payments are $198,539. The cost is $726,426 and it's a 10% return. 10% interest rate. Okay, now the way we did this is a guaranteed residual of $50,000, and the expected residual is $50,000. So the lessee doesn't even worry about the guaranteed residual. Now, to get the only thing a residual will do would be lower the payments that the lessee has to pay. Okay, so the cost of the asset was $726,426. Then what we'll do is we'll subtract the present value of the residual value. So at $50,000 at 10% for 4 years, that comes up to $34,151. Okay, and I did that by doing my present value tables with my round function. So this is the recoverable cost that we want, the $692,275. That's how much we plan on recovering from it. So to get our payment in, we do the payment function 10% for 4 years on $692,275, and that comes to a payment then of $198,539. Okay, so you notice on the lessee side of the books, which is what this side is over here, I start with the $692,275, which is the present value of the payments. So if you took the present value of the payments of $198,539, that would give you the $692,275, and that's what everything's based off of on the lessee side. But for the lessor side, we want to do the present value including the guaranteed payment, and that's why you'll see this equation. You'll have this is the present value of the lease payments, and then this is the present value of the guaranteed residual. The two added together is what we put in here for $72,427. That's our starting place. And then this is going to be the same we had before for the payments. Okay, so that won't change anything. Remember, these are done at the beginning of the year, so that's why they're in here like this. And make sure I have them all. Oops. Oh, I did it again. The last year is $50,000. Okay, that's why it's different. The $18,539, and I think I copied the wrong number down. There we go. Okay, so 726 minus the 198, and then our interest revenues equal the round function, the 10% times the balance of 527,888, no decimals. Okay, and then this is the 198,539 minus the 52,789, and then we subtract those off. And if we did this right, we can just copy them down. And I forgot again to do my normal thing of absolute valuing that first one. Okay. And that's off $1. Okay. And again, to get rid of the decimal point, the dollar signs, don't really need those in there. Okay, so the charts, you notice these charts are done pretty much all the same way. So there's no difference between the charts. So, except the beginning, how you calculate the beginning balances. The lease receivable, this is just a regular no profit. So those will be the same. And then the cash payment is the 198. That's the cash payment over there. And the lease receivable is the 198. And then the second one is equal to the 198. And then we have the lease receivables 145, and interest revenue is 52,789. Again, because this is a lessor, we don't do the depreciation. You notice the amortization expenses over here. So over here is the cash payment. This is for 21. That's the 198. The lease receivable is the 160 and the 38. And then in 2022, there's my cash payment. Lease receivable is the 176 and interest revenue. Okay, then when I get the equipment back, that's coming back at 50,000, and the lease receivables 45, and interest revenue is 45. Okay. Now this is for the guaranteed, or basically just could be a residual too. They're guaranteed to 50,000. Could be by the lessee. It could be by a third party. It doesn't really matter. The only time the lessee worries about the guaranteed residual is that if he guaranteed it for 50,000, but the expected value would be, let's say, 30,000. So then he would have to include in this price here the present value of the difference, which would be the 50 minus the 30, or 20,000. But it's the present value of that difference. Okay, so he only has to, the lessee only includes the amount they expect it to pay for the guaranteed residual. If it's unguaranteed residual, they're still expecting the 50,000, so that would still lower the payments, even though it's not guaranteed. Okay, and if they came back at 20,000, then you would have a loss from lease of equipment of 30,000. Would be another debit in here, but that's the only difference between those two. Okay, and that is a guaranteed residual. Basically, it's done the same way we've done all the rest of them, but for the lessor, you include the guaranteed residual in the present value calculations, and it reduces the amount the lessee has to pay because the lessor is getting the equipment back. Okay, now the next one we have is the bargain purchase option, and the reason why I think I can do it because it's done basically the same way as for the as this one is doing, and so it's not a lot different. This is where you have the lessee has an option to purchase it, and we have we're pretty certain that they're going to purchase it. So this one, both of them include the residual. Okay, so we go through the same calculations we just went through, and that's what this is here, the present value of the lease. And you notice it includes both the present value of the lease payments and the bargain purchase option. Okay, so that's our starting point. So this would equal the, okay, and for the payment then, it's the 198,539, and that's going to be for that one. So this one doesn't change any. As far as both of them are going to use basically the same table, except the last one again is going to be the 50,000, just like we had before. Okay, so the table is going to be the same. The difference is now this is both for the lessee and the lessor if it's a bargain purchase option. Both of them included. And again, you subtract off the amount to be recovered by the lease payments is subtracted by the present value of the bargain purchase option, because at the end we're expecting to get the 50,000. So you don't want to have to charge, you don't charge them twice for it. So, okay, and then you subtract that off. And then you do this, everything's done the same way. It's the 10%. This time make sure it's F4, the absolute value, times the balance, comma 0, whoops, comma 1, comma 0. Okay. And then this one is the difference, subtract the 198 minus the 52,789 and the 527 minus the 145,750. And then if I did it right, you can highlight that and copy it down. And again, get rid of the decimal place, the dollar signs, and we're off $1 because of rounding. Okay, so that takes care of that. So that's our tables, done the same way we've done all the rest of them. And again, this is a regular lease, so it's equal to the 726,427. 726,427 is the equipment. The first payment is the 198,539, and lease receivable is 198,539. And then this is the first payment. Is the cash is, well, for the end of the year payment. Okay, 198,539. Then you have lease receivables 145 and 52,789. And then you notice we don't do depreciation again because this is the lessor's books. 160, 38. Okay. And then this is 176,358, 22,181. So you see that this really doesn't change a whole lot. 176. Oops, I get that in the wrong, didn't I? I got the wrong thing there. Let's try that again. Equal, I got on the wrong set of books. Okay, 198, that's the cash received. That's 176 and 22,181. Okay. So that takes care of, oh, I got in the wrong set of books again, didn't I? I got in the wrong line. This is the last one, sorry. Oh, this is a 50,000 one. Okay. I really messed that up, didn't I? This should be 50,000. That's when they get the cash at 50,000, and then they still record interest revenue. Okay. For the lessee, I'm going to do something here. Let's go to view, and I'm going to split the screen so I don't have to go back and forth. The right to use asset is the 726. So this is the same we had been doing. Lease payment is for the first cash payment. Oh, that is the lease, decrease the amount of the lease. This one is your cash payment. And then in the year, the lease payable is 145. Interest expense is 52,789, and the cash is 198. Then we need to calculate the depreciation, and that's going to be the 726,427 divided by 5. And this is where it's a little different also, is why I wanted to go over this side, is because it's divided by 5 because you're buying the asset, even though the lease is for 4 years, you're going to keep it for 5 years because you're purchasing the asset. So that's why it's divided by 5. Okay, and because of the rounding, that went to 7. I'll change that number so you okay, that's 726,427 divided by 5. Okay, so you know where that came from. Okay, then on to 2021, lease payable equal, okay, and then the cash, and then this is going to be equal to the same dollar amount we had up here. Okay. Oh, I forgot to do something, sorry. Yeah, that's right. Because there's no residual value, because we're assuming residual value at the end of 5 years is 0. Okay, so that's why we don't subtract off the 50,000. So that's why it's just a 726,427 divided by 5. Okay, because we're assuming that, it says here residual value at the end of 5 years is 0. At the end of 4 years is 50,000. So we just don't worry about it. It's going to be 0. Okay, in 2022 then, it's 176, 22, and 198. Amortization expense is the same dollar amount